Everybody, it seems, at least the retail investors, seem to be fixated on the stock market.
When you understand the bond market, you really start to understand the global economy.
People that really know what's going on are really focused on the bond market.
It tells you, are you seeing inflation or deflation, growth? It really tells you what's going on.
The president's trying to push the stock market for perception, right?
Whereas the equity market, like I said, it's sexy, it's fun. You tell your friends about it. You don't tell people like, hey man, I bought some bonds. And we're like, what's wrong with you?
By moving the bonds, then it moves the stock market.
And I don't think we've ever had a president that really could almost move the market with a tweet.
And then it becomes a self-fulfilling prophecy. More people start buying, and then it goes up even more. But then what is Fed Chair Jerome Powell doing?
And a lot of this market is run by computer algorithms.
Hey everyone, welcome to another episode of the Market Disruptors Show. And today I am sitting down with Steven Van Metre. He is taking the social media world by storm, I guess you might want to call it that, with his really good analysis that he's been doing on the markets. He's been one of the most requested guests that I've had recently, so we decided to have him on. And I've really been enjoying your work. And Steven, it's a pleasure to have you on the show. Thanks for joining us.
Mark, it's a real pleasure to be here today. Thank you for inviting me.
Yeah. So, I've seen a lot of stuff that you've been doing, a lot of good analysis, specifically around what the Fed's doing and the bond, QE, et cetera. But for those that don't know who you are, just give us a little bit of background on what you've been working on and kind of what you're doing.
Sure. I've been a financial planner and financial advisor for, I think this is my 19th year in the business. I tend to not worry about the little details of exactly how many years. I manage a macro fund, and I also invented a formula-based long equity strategy called Portfolio Shield. And other than that, I am the self-anointed bond king, as many of your fans know.
Yeah, the self-appointed bond king. So talking about bonds, we'll just go ahead and dig into that for a minute. So I've been kind of looking and talking about how everybody, it seems, at least the retail investors, seem to be fixated on the stock market. But it seems like the people that really know what's going on are really focused on the bond market. Is that true? And if so, why?
It's 100% true, because let's say that you and I go out after the show and have a beer. Well, how fun is it we could talk about Tesla or, other tech stocks. And that's what people are excited about. They want to talk about, what they think is going on with those stocks. If we were sitting there over a beer and talking about 10-year treasury yields, it seems pretty boring. And,
right.
That's the way people approach the bond market. It's not very interesting. There's no sex appeal to it. But the reason you see certain people focus on the bond market is because the bond market's actually bigger and deeper than the equity market. And when you understand the bond market, you really start to understand the global economy. The stock market itself it can tell you that, but certainly doesn't tell you how things are going like the bond market does.
So the bond market really tells you more about the global economy. Is that because we're in a debt-based economy and bonds are debt?
Yes. Yeah, that's a perfect example of that. It tells you, are you seeing inflation or deflation, growth? It really tells you what's going on, because the stock market doesn't always tell you that. You can look at the stock market and see a lot of emotion in it. The bond market, there's really not that emotion. It is what it is, and it's more dictated by the monetary system. So the system itself, that controls all of the money, the bond market is a huge piece of that. Whereas the equity market, like I said, it's sexy, it's fun. You tell your friends about it. You don't tell people like, hey man, I bought some bonds. And we're like, what's wrong with you?
Right. Well, I think, the retail people own the stocks, right? The boomers are looking at their stock portfolio for their retirement. The president's trying to push the stock market for perception, right? But at the end of the day, really, I guess what the Fed is doing is all about bonds. And by moving the bonds, then it moves the stock market.
Well, let's touch on why President Trump pushes the equity market so much, because that is something he does, and he's oddly very effective at it. I don't think we've ever had a president that really could almost move the market with a tweet or a press conference. And this is kind of interesting to me. People have opinions about President Trump on either side of the fence, but somebody in the White House, and I don't know if it was him, understands that 70% of the economy is consumer consumption. And I don't know about you, Mark, but when I feel rich, I tend to spend more money. When I feel poor, I tend to spend less. Well, how do you make people feel rich? Well, you drive stock prices up and get people to say, hey, I'm getting richer this week or this month and this year. I'm going to go out and buy that new home, car, whatever it is I want.
Yep.
And that's pretty interesting that he's figured that out and that he's really, seems to be able to push the market to his favor.
But how has he been able to push the market other than a tweet? So he puts out a tweet, which makes people feel warm and fuzzy, and then they just go spend. I mean, don't they actually need to see the stocks going up?
Right. Well, they do. And a lot of this market is run by computer algorithm. And since the great financial crisis, what's happened is you've seen some effectively black box computer programs that are actually what we call in the industry algos. And they're actually reading the news. And there's actually computer programs that are written to translate the news to them. So when they see certain things and their algorithm says, hey, that's market positive, well, they start bidding prices up, and then everyone says, wow, Trump just tweeted about something. Wow, right. The market's going up. Well, I'm going to go home and, buy. And then boom, 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 it drives it up.
Yeah. So the algos are looking at sentiment. So they're looking at the different conversations and seeing if people are talking bullish or if they're talking bearish, and then they're trying to trade off of that, or at least put that into their equation. So if his tweet alone is enough to maybe push the algos and make everybody feel warm and fuzzy and go buy, and then it becomes a self-fulfilling prophecy, more people start buying, and then it goes up even more. But then what is Fed Chair Jerome Powell doing? So when he goes out and he says that we're going to basically, QE infinity, we're basically going to, all these things that he talks about, right? Backstock the economy. What is he doing by saying that?
Yeah. So the real question should be is, why is he doing QE in the first place? So what is the role of the central bank or the Fed in our economy? And their role is to create a certain level of inflation. And we've heard them say they want 2% inflation. Now, why do we want that? Well, in a debt-based economy, the goal is you want to slowly inflate away that debt. So Powell's role is to come out there and say, okay, we have the tools and mechanisms to create inflation. Now, the odd part is they actually don't. And so the reason they do quantitative easing, which is widely misunderstood. So most people think, oh, the Fed's doing quantitative easing to create inflation. That's not actually the case at all. The Fed does quantitative easing when the economy is deflating or they feel the risks are very high that the economy will deflate. So it's exactly opposite what people think the Fed is doing and why they're doing it.
Well, but if the Fed is doing quantitative easing because the economy is deflating, but then they're doing it in order to re-inflate it. So wouldn't it be considered inflationary? They do it when it's deflating, but in order to get it to re-inflate?
It would if quantitative easing was inflationary, and that's the problem. The quantitative easing is not inflationary at all. In fact, I use the phrase QE is deflationary until it's inflationary. Everyone's like, huh? Well, okay, so the question is, what does quantitative easing actually do? I mean, yeah, we can go in and look at the mechanics and see how this, behind the scenes, what the Fed is doing, but what is the real purpose of their actions? And that is to lower interest rates. Now, why would the Fed want to lower interest rates to create inflation? Well, it's pretty simple. We come back and ask the question is, how is money created in our economy? And it's created when consumers and businesses borrow. New money is born inside the banking system. Right. The Fed actually cannot create money. They do not have the tools or the abilities to do that. So how do I get you, as if I'm the Fed, how do I get Mark Moss to go out and spend money? Well, I know if I raise interest rates, he's probably not very motivated, but maybe that car that he's had his eye on, if I can get rates down low enough and you go, okay, I'm going to go do it, that's the goal. Now, the problem is, and what we learned from late economist Milton Friedman is that lower interest rates actually tighten financial conditions. Of course, that kind of seems, well, wait a minute, Steve, that seems completely opposite of what I've heard.
Yeah.
Well, think about it this way, right? Let's say that I was going to lend you money at 2% for 30 years. Do you think I'd really want to do that?
No.
And what's my risk? What if you don't pay it back? My profit margin is not much.
The risk to reward is off.
is way off. Well, the banks know that too. So what happens as rates go down, banks usually start tightening financial conditions. They have zero incentive to lend. And all of a sudden it gets harder and harder to borrow money. In fact, I was talking to my partner today at my securities firm, and he was like, yeah, he's like, we just refied our house, and his wife works in the government sector. He said, the day the loan was going to close, and he was 4 times they confirmed her employment there, and the day before they wanted a phone call with her boss, because that's how tight financial conditions are. Banks are decentivized to lend right now. Now, at some point, interest rates will get low enough, the economy will shrink or crash, we'll have a recession, and the government will come in and say, okay, we'll backstop these loans, and then the banks will say, okay, cool. If my risk now is going to effectively zero, well, have at it. I'll just start, I'll loan to anybody.
Right.
That's why quantitative easing actually is deflationary until it's inflationary, because it doesn't actually create any money. And that is the biggest myth propagated by the Fed today. We've heard Fed Chair Powell say in his 60-minute interview that the Fed is creating digital money. No, they're absolutely not creating a penny. And that's why you don't see that.
Isn't a lot of it semantics in a sense, right? Where it's like, are they printing money? Well, of course, there's no money printer today. It's just digital. And so like a lot of it's like semantics. But if money is created through debt creation, right? Which is what you said, right? So money is created through debt creation. Well, in order to create more debt, I need more reserves. So if the QE gives me more reserves, I can create more debt, which does kind of print more money.
Well, kind of. So the problem is what quantitative easing does is you're correct. It creates bank reserves. And so there is a mechanism for that. And what it does is it's called a reserve swap. So if you look at banks, they will hold U.S. Treasury securities and mortgage-backed securities as reserve assets. Now, that doesn't mean all of them that they own there, but they do hold them in their reserves. So all the Fed comes in and does is say, okay, here's the deal. You're going to give me that Treasury security. I'm going to give you a reserve asset. Now, people look at that exchange and go, aha, they printed money. No, because they removed one asset from the bank's balance sheet and gave them another. And then that Treasury security the Fed took, while we see it on their balance sheet, we can go to their website and say, yeah, there it is. We can account for it. It's effectively removed from the system. You can't buy it from the Fed. You can't, short it from the Fed. It's essentially removed from the system.
Right.
So from a bank's perspective and the economy, there's no net change in money created.
The bank can't access it because it's held away from them. They can see it, but it does allow them to create more money.
Okay, well, that is the purpose. Okay, from the Fed's perspective, what a reserve asset is designed to do in their mind is for the banks to lend against. But one of the problems that people don't understand about reserve assets is they can't leave the system. So when a reserve asset is created, it's actually held at a Federal Reserve member bank. Mm-hmm. So the bank can't actually take that money out. Now, it can move in between the system. And what I mean by that is the ownership of that reserve asset can change. So if I was a bank and you were a bank and you had a Treasury security and I had a reserve asset and you said, man, Steve, I really need a reserve asset right now. I say, well, man, Mark, I really need a Treasury security. We could swap.
Right.
But it doesn't leave the system. So and that's a really key point to understand is the reserve asset cannot leave the system. So because it can't leave the system, the banks can lend against it, but they actually have to risk their own capital. So if a default occurs, well, now the bank's they've got to eat that. Right. And the borrower still has to risk their own collateral. Right. It's not a perfect situation. So, and if you look at, we have, trillions of dollars in all these reserve assets piling up in the banks, and they're still not lending because the banks cannot be forced to lend by the Fed.
At least not yet. But that's the
Fed can't do that. That's not something they can do.
So the risk reward ratio is definitely off. They can't be forced to do it. And so really, if we look back, like we see, QE really came into prominence after, 2008 great financial crash. And I think a lot of people look back to that and say, well, we did QE and we didn't have the inflation. And so it's not inflationary, as you said. But then some people would say, well, we did have inflation, but it all happened in the financial sector. So now we have this, we do have inflation with all these financial assets. Is that accurate, or you don't think it created inflation there either?
Well, again, it comes back to quantitative easing does not have anything to do with any financial asset. There's no stock trade involved in it. There's no housing trade. But there's this belief that as the Fed increases the monetary base, and let me be very clear, not the money supply, the monetary base. The Fed has zero control over the money supply, but they can raise and lower the monetary base with quantitative easing. There is this myth that's been propagated that as the monetary base rises, for some reason, my house increases in value and your stocks increase in value. And it's simply because the Fed is doing quantitative easing. There's no evidence to support that at all. What's happening is people believe that's what it does. And so if I believe the stock prices go up because the Fed is doing QE, well, what's the smartest thing I can go do with my money, Mark?
Yeah.
Buy stocks.
Yeah.
And then I think, oh, well, housing must go up because of that too. So what do? I go out and buy a house. Well, if everyone starts buying homes and stocks because they think the Fed makes it go up, guess what? They go up in value.
Right. And that's a great point that I wanted to talk to you about. So just like Trump is tweeting out and almost bluffing the market, it also appears that Jerome Powell has maybe been bluffing the market, saying they're going to do all this intervention, but really not. But just by saying they're going to do it, they're going to backstop the economy. They're going to do whatever they can to prevent it from crashing. It encourages people to go out and buy because they think the Fed has their back. Is that correct?
That is 100% correct. So the Federal Reserve has a lot less power than people think it does. And I'm not just saying Powell, you can go back through central bankers.
Sure.
And so the whole game of the Fed is if I can convince you of anything and you go do it, it becomes a self-fulfilling prophecy. So let's say that you believe stock prices go up because I do more quantitative easing. So you go buy stocks, and then all of a sudden, because more wealth is being created as people chase it up, they feel richer, so they then go out and say, I'm going to go eat out more and spend more money and buy a new car. Well, all of a sudden, now money's being created as money starts moving around and it gets borrowed, and now you've got this self-fulfilling prophecy. And that's why you'll never hear any Fed chair or any member of the Fed come out and say, yeah, you know what, QE doesn't do any of the things that you think it does. They want you to believe. Because the more you believe, the more it becomes a self-fulfilling prophecy. Now, if it did work, and here's a perfect example of it, if anyone watches or listens to what Fed Chair Powell says, lately he's been going around telling Congress and anywhere he can speak is more fiscal stimulus, more fiscal stimulus. Well, wait a minute. Whoa, time out. If quantitative easing works, why do we need more fiscal stimulus? Because he knows it doesn't actually do anything. And he doesn't want anyone to figure out that it doesn't. Right. So if he can get the Congress to issue more fiscal and by some stroke of luck it works, or if it doesn't work, he can say, hey, their fault. They didn't do more fiscal stimulus. I did my part. It's all a big game.
Right. And yeah, we're starting to see some people that are paying attention are starting to see that the Fed doesn't really have those tools. What is the difference then between what the Fed can do through its QE and then the fiscal stimulus?
Well, all QE does is it's a swap in reserves.
Right.
I mean, it literally does absolutely nothing else. And the idea then is, okay, banks are going to lend off of this, but because they have to risk their own capital, they're really not motivated in the current economic climate. Now, fiscal stimulus is simple. Congress is going out borrowing money and giving it to people and hoping that they're actually going to start spending it on discretionary goods and services, and then the money will start moving around the economy, and that will create inflation and growth.
So instead of money accumulating at the banks, fiscal stimulus goes directly out to the people from Main Street from Wall Street to Main Street, which then increases the spending. But
even worse than that, when the U.S. government borrows, they borrow from people all over the world. So they borrow from foreign central banks, foreign investors, U.S. investors, everybody. And so the way I like to look at it is they're kind of pulling in dollars from around the world and they're redistributing. So they're taking them from people who have and giving them to people who they perceive need them or will use them. The government is a redistribution machine for dollars.
Sure. Yep. I always say that the government can't create anything, right? They just redistribute everything. So, so we've talked about QE, and that's kind of one of the Fed's tools, and maybe they only have two tools, and the other one would be interest rates.
Correct.
Right. And so we talked about interest rates briefly, but that's the other tool they have. And interest rates, low rates are deflationary, as we've already talked about. But we've gotten to a point now where interest rates are basically at zero. And I know none of these things are easy to understand because they're so intertwined, right? But like in your example you used, that the Fed can't really get the market, stock market, or the real estate to market to go up, but they can make me feel better about it. So I go buy real estate or buy stocks, which cause them to go up, which is partially true. However, when interest rates are low, then as a corporation, I can borrow to buy my stock. Or when interest rates are low, I can go buy that house. Mm-hmm. And when I buy that house, then whoever I bought it from has money and they can go do other things with it as well. So in a sense, even though maybe the QE didn't cause it, the low interest rates in a roundabout way did cause the stock market or the real estate market to go up.
Right. And that's the whole game is what you can convince people to do with their money. They just so happen to be right now, they're picking stocks and they're picking real estate. And why is that? Because let's say we do get really high inflation, which is what the market believes. Well, what do I want to own? I want to own, hard assets, real estate, gold, potentially cryptocurrencies. They're still new enough that we don't know exactly how they're going to act in the future, but they'll probably do fine in high inflation. And you want to buy stocks because, hey, if that's what's going to happen, then that's what I need. The question comes is, what happens when it doesn't work?
Right.
We saw that in March, and a lot of people look back to say, well, March was an anomaly. Well, it couldn't have been. Fed was actually doing quantitative easing then. Oh, well, they just weren't doing enough. If they would have done more, we wouldn't have seen that. And that's the big problem that will happen is how are people going to react when QE doesn't actually do anything because it doesn't do anything, and then they figure it out.
Well, and I think we can already see that it's been having diminishing returns, right? So it's worked, and then it works less and less and less, and then eventually it just doesn't, right? So it works until it doesn't.
Well, sure, because at some point, everybody that wanted to buy stocks bought them. Everyone that wanted to buy real estate bought it, and the economy underneath is still weak and not creating enough money and enough growth for more people to go out and do it.
Yeah.
And so QE doesn't fix that problem.
So now that we understand the Fed and the two tools that they really have at their disposal, now they have these two tools at their disposal. Almost like if I was driving a car, I have a gas and I have a brake. Those are my two levers. But I'm reading the road, right? So I'm reacting to the road using the two levers that I have. And the Fed has two levers, and they're trying to read the road. And what they're trying to read is inflation. And so they have this target of 2% supposedly, right? And,
yes.
And they have
that is their target. They really want 2% inflation.
Right. They really want 2%. And they haven't been able to get it. And now they said, forget it. Now our target is an average of 2%. Let it run hot, all these things. However, in order to look at that, like their little gauge on their dash of inflation is the CPI. And it seems like the CPI, I've heard you talk about the CPI. It seems like the CPI has been a moving target. So they've changed the way CPI has been calculated. And if we looked at CPI like we did in 1980, we got a ton of inflation. But if we look at it today, we don't. So how do you see that?
Well, let's go back to the two tools, because I think that's a good starting place. And I look at the Fed as a golf cart, right? I mean, it's forward and reverse. Okay. I mean, you push one pedal and you either get one action or the other. And quantitative easing and the federal funds rate, they do the same thing. So when the Fed lowers the federal funds rate and does quantitative easing, they both lower interest rates. That's exactly what they do. And when the Fed raises the federal funds rate and they do quantitative tightening, that causes interest rates to go up. Okay. And so yes, they do use the consumer price index. They also use the personal consumption expenditures as their barometer for inflation. And and that's their choice. I mean, I don't make that rule up. It's a lot of people are kind of critical and say, well, why do you follow it? Well, it's because it's what everybody uses. I mean, if there's a benchmark in your industry, even if it's flawed, you got to use it because that's what everyone else is looking at.
Right.
And so, yeah, that's what they look at. They obviously feel strongly about it. And probably one of the reasons why they've modified it over the year. And remember, it's not the Fed that has actually changed this. It's the other government agencies that create these indices for the Fed.
Okay.
Or just these government statistics and the Fed happens to use them, is because if I can artificially keep that a little bit lower than it should be, then I could theoretically print more money, even though I'm not actually printing money. But I think that plays into the psychology of this, is, well, we'll just use a statistic that's a little weaker than the actual statistic, because let's just say we used a 1980s gauge of the CBI. Well, what would happen? The Fed would have to start raising rates.
Right.
That wouldn't really be good right now.
Right. And that was exactly what I was thinking. And I was just trying to get your take on that. So maybe they are changing the goalpost, if you will, pushing the goalpost back in order to continue with their policy that they want to have.
Right. But the key understanding here is the Fed does not create the consumer price index or the personal consumption expenditures index that they use.
Right. So it's another agency that's doing that.
Correct. Yeah. I believe it's the Bureau of Labor Statistics that does the CBI. I'm not sure if they also do the PCE or not. So, now, obviously someone will say, well, they're obviously in cahoots. Well, some of these agencies are fairly independent of others. So I don't know that that's entirely true, but the Fed does get to kind of pick which ones they want to use. So there could be some bias there for sure.
Yeah, I've been working on doing a video on it, and it's taken me a while, but I've been using the shadow stats information that they have, and really studying into the CPI and what the BLS does. So it's a work in progress. I'll come out with it, but it looks like if we use like a 1980s number, or I should say the same model that we had in 1980, we have like 18% inflation. It's like crazy. Don't hold me to that exact number because it's still a work in progress, but somewhere in
I won't, because people are very critical of me, and they say, why don't you look at these other things? It's like, because this is the benchmark my industry uses. I have no choice. Whether I agree with it or not, it doesn't matter. And it doesn't matter whether those are more accurate. Is everybody's using this. So this is what I'm going to use.
Sure. Well, it makes sense. I mean, I think we have to look at it, these things are multifaceted, so we have to look at them from different angles. So for sure, we have to look at the benchmark the industry gives us, because that tells us what the Fed policy is going to do.
Correct.
But as an investor, as someone taking personal responsibility for my own self, I also have to understand what's really going on, maybe beyond their policy. So you got to look at both. You got to hold both ideas in their head at the same time, maybe.
Yeah, I mean, I think as a money manager, it's a little different, because if I was actually, running my investment strategies based on, say, let's just say your 18% number is correct, and we'll both agree that we don't know.
Sure.
Well, I'm going to have a much different investment allocation than I would if I'm following what the Fed is kind of saying is the benchmark. So there is a point where you can say, well, I know this to be true, but I can't really use it. I mean, and I know it's true in day-to-day life, but that doesn't matter.
Well, let's talk about that for a minute, though. So, like a takeaway that somebody could get. So, the Fed's saying there's no inflation, and so I'm investing according to what I expect from the Fed, right? This macro lens. But on a personal level, I do have to account for prices going up. I mean, food's gone way up this year. Everything's gone way up. So I do have to kind of manage for the amount of cash flow that I need. So from a personal financial planning perspective, is that important to kind of understand to help adjust my plan properly?
It is. But the problem is people don't actually believe that things go down in price either. So one example is I lease cars. I've leased cars for 18 years. So about every 3 years I do. I know some people listen to this and are like, what a complete waste of money.
Right.
Well, maybe, but I'm really busy. I want to make sure my car is under warranty. I don't drive a lot, and I don't buy really fancy cars generally. So to me, it's not really a big deal. Well, the lease on my current car is $113 a month. It's the cheapest lease I've ever had. So I could look at that and say, well, I've had more expensive leases than I have now. So that is deflationary. And I can look at other things in my budget and say, okay, well, my cost of internet is kind of around this level, but every couple of years, they boost my speed up. Well, that's disinflationary. So, people, I think, just want to see that prices are always going up, even though they aren't. I mean, you have to kind of look at the big picture and say, okay, maybe some of these things aren't going up that much, or maybe they're not going up as much as other things.
Right. Getting a bigger perspective. So I'm talking about that. So then the inflation versus deflation debate. So back to, shadow stats says we're inflationary. Fed says we're not inflationary. What they're trying to do is maybe inflationary, but it's actually getting deflationary. I kind of look at it as like inflation is this big balloon that we filled up with debt, whatever, a couple $100 trillion worth in the last 50, 60 years. And it keeps trying to deflate, and the Fed keeps trying to pump it back up, and it deflates again. Is that the battle that's going on? They're constantly just trying to keep this balloon inflated while it's trying to deflate. And if so, who wins that battle?
Yeah, that's not quite exactly right. So we're in a debt-based economy. You mentioned that earlier. And
Right.
so how do you get economic growth? Well, believe it or not, you
More debt.
get it by more people, by more debt. I mean,
Yeah.
as much as, I know you and other people talk about, living within your means and all of that. The reality is we're an economy that if I'm debt free, someone else has to have more debt because I don't.
Right.
And that's the whole name of the game. And so it's not that the debt so much is deflating, because that's clearly not the case. We're really, the debt is growing on a regular basis.
But it
It's
is
just,
deflating if somebody defaults. I mean, I could
well,
default on $1 million and it's gone.
right. But the issue isn't that, it's just the debt isn't growing at a fast enough rate.
Okay.
That's the problem. And so, the Fed really needs to see the debt growing at a certain rate to get enough economic growth to keep people from defaulting on their loans and all of that good stuff. The problem is they don't have the tools or ability or mechanisms to accomplish that goal.
So do you think we're getting to the end? I mean, they don't have a strong enough air pump to blow it up anymore. Like they're not able to get the inflation that they need anymore. And so now we're going to start this slow decline, or maybe even a rapid decline, into more of a deflationary cycle.
Well, we've seen disinflation for 40 years. I mean, if whether or not people agree with the consumer price index, you can look at treasury yields, you can look at other things and say that, yes, we have not seen the same rate of inflation as we saw in the 80s. And even if we went, say, to shadow stats and, then their version of the 80s was probably even more than the official version. The problem with low interest rates is it destroys money really quick. So here's a great example. We talked about money's created when people borrow. Well, there has to be an opposite reaction to that. Money just isn't created and just stays in the system perpetually. It is destroyed as people make a principal payment toward their loan. So, in a payment, they have interest and principal. As you make that back, the principal is actually destroyed, removed from the system.
Right.
So when you get down to the zero bound, right? So let's just say after the show that you and I go out and we want to get a new car together. And so we buy a $60,000 car at 0% interest. Well, we finance it. So $60,000 comes into the economy, but every month as we make that $1,000 a month payment, money's being destroyed.
Right.
And at the end of 60 months, it's all gone. Yep. Well, the problem is when you're at a low interest rate bound, you need so much in new loans being created all the time to offset all of this currency destruction from low interest rates that it's a self-fulfilling prophecy. You're going to get disinflation and deflation because you have to have so much borrowing going on. And there's just no way that's going to happen.
Yeah. The system is just inherently flawed because the debt system just can't continue at some point. I recently had Jeff Booth on the show. He wrote a book, The Price of Tomorrow. I'm not sure if you've seen that. No. He's definitely an interesting guy. I think he was on Real Vision recently as well. But he wrote a book called.
I may have actually. Now I know who you're talking about. Yes.
Yeah, he wrote a book, The Price of Tomorrow, and he basically said that everything we do is deflationary. Like humans, everything we try to think about is deflationary, meaning I want to accomplish more with less work, right? I'm going to invent a lawnmower so I don't have to sit there with scissors, right? Like everything we do is deflationary. I remember as a kid watching the Jetsons, and like there was like a robot, and I'm like, oh, how cool would that be if I had a robot that could clean my house? And that's deflationary. Like we want that world, but at the same time, our financial system is trying to fight the world, and so it's fighting against nature, which doesn't seem like a good war, I guess.
Yeah, I totally agree with that. If you want to see people working in inflation, start ripping away all this automation, and all of a sudden people are going to have to work. I mean, we keep hearing more and more that at some point technology will get to a level where most people will not need to work. Well, that's not inflationary. Yeah. What I want is, factories full of people assembling things and doing all that. Well, that means lots of people are getting paid, lots of money is moving around, and lots of things are happening.
But we don't really want that. I would love to have a robot doing all my work for me. I mean,
well, not if there's perpetual deflation, you wouldn't.
I was in, I'm a surfer, so I travel all over the world to surf in the most remote places that we can get to. And I was in Nicaragua, and one of the poorest places that I've been to. It's really poor there. And the same stretch of road that I've been going on for years. And like they're making no ground on this road. It's still mostly dirt and very rough. And they're out there literally by hand laying these pavers. By hand, pavers, like not even concrete or asphalt. And I asked the locals, like, what is going on with this road? Like, they're out there laying brick by brick. Like, why not just bring a tractor out here? Oh, because the people need to work.
Yeah.
People need to work. Like so they're inflationary, getting people to lay bricks by hand when they could just bring a tractor and get the road done in a year, which I think is what I would want. But I guess different people see that differently.
Yeah, well, and that's why back when Japan, and of course they're still going through a lot of their problems, they would do just fiscal stimulus after fiscal stimulus, and you would hear stories where they'd pave a whole stretch of road, and when they got done, they'd tear it all up and pave it again. Yeah. Tear it up, pave it again. Keep people working.
Now, we talk about being in a debt-based system compared to a system that's not built off debt, like we had with the gold standard, right?
Well, the gold standard was still debt-based. What you're referring to is a savings-based system.
Oh, okay.
So the gold standard, there's still debt there. The difference is gold limited how much money could be created. Once we went off the gold standard, the banking system actually took over and said, look, we can create money now as long as people want to borrow and move it around. Whereas under the gold standard, it said, look, you have X gold, you can only create X amount of dollars.
Yeah. So in a savings-based economy, then I should be able to specialize in my work, put the money aside, and have it store its value, which then if prices were getting cheaper over time, but my value was retaining its purchasing power or increasing its purchasing power, I should be able to work less and still enjoy my same standard of living, theoretically, right? That's how it's supposed to work.
That is exactly how it works.
But we don't know because we don't have that.
Well, there's a reason why. If you really want to go down the rabbit hole.
I love rabbit holes.
Which is funny because my wife and I have a little pet rabbit. And until you get one of those things, they're kind of weird pets. But when she watches this, she'll get a kick out of that. So think about this. If we're in a savings-based system where you're actually, your money holds value and you can actually end up working less, well, why is that a problem? Well, because in our system now, we have some people, some families that what I'll say is generational wealthy. Now, you'll see year after year, decade after decade, certainly some people fall off and some people get added in, and you'll get people like Zuckerberg, they'll get very rich. The question is, can they hang on to that wealth? You also look at the government, a lot of power being in politics. A debt-based system is designed to keep a very small number of the population extremely wealthy. It's designed to support large government. And as the same argument, it also is designed to keep people working. Now that seems really weird. And here's why. There's a limited pool of dollars in our system. And if we took all those dollars and tried to pay off every debt that existed, there are not enough dollars out there to accomplish that. So in any given day, we all compete with each other. So right now, Mark, I'm competing with you to get dollars. You're competing with me. All of your listeners are competing for dollars. There are some that are very good at it. So say Mark Zuckerberg, excellent at getting dollars. Elon Musk, very good at getting dollars. And there are some people that aren't, and they're on government assistance or they're homeless. So every day we're out competing for dollars. Now, if I've got to go out and compete for dollars every day, and you've got to go out and compete for dollars every day, what do I don't have time to do? Overthrow the government.
Yep, I get it. And so I get why the system is the way the system is. It's just not the system that it seems like it's the best for humankind. And going back to a very old example of this, a biblical example, the Israelites lived under Pharaoh, and he looked out and said, "Oh, there's way too many of them. What are we going to do? I have an idea. Let's turn them into slaves and work them so hard they'll never have time to overthrow us." This was thousands of years ago they said this. So it's been that way ever since. And that is a good conversation that I would love to dig into that rabbit hole. But I know we're running short on time, and so we don't have time to go down that whole rabbit hole. But you've definitely given us enough of a taste, and maybe we'll have to have you back on for a talk on that. What I do want to talk about before we run out of time is where we're going and how the average person should be thinking about this, or what they should be paying attention to navigate this. So if we've been in a downward deflationary path for the last 40 years, we're probably going to have
let's say disinflationary.
Disinflationary period. And there's a very good chance we might have even more, or maybe even more rapid rate of disinflation in the near future. how does somebody think about that? What are they watching? How do they navigate that?
Yeah, I think the risk now is again, we're going to have to use the consumer price index as the barometer because it is the barometer. Is it's running at such a low rate that the risk is now we're going to get outright deflation. And the problem is if you're in debt, deflation is your biggest enemy because
Sure.
now all of a sudden there's even less money for you to pay on your debt. So unless you're really good at going out and getting dollars, it gets really difficult. And then you've got this whole game of musical chairs being played under a deflation scenario where more people are not having chairs to sit in at some point. And so they lose their homes, they lose their businesses, lose everything. Now, if you're a saver, if you've got money and you've been waiting for opportunities, deflation is your best friend because as soon as asset prices start collapsing, now you're going to go out and buy it. Problem is, not many people are in that position. And if you look historically, savers are the ones who get rich through recessions by buying up all these cheap assets. But that's what will likely happen is I expect that even though we're in the middle of a recession now, and it doesn't appear to be that we are, it is going to get worse. There will be a deflationary shock. We will see a repeat of the great financial crisis. It will most likely be worse. What will happen after that is anybody's guess. I'm sure the Fed will do a lot of things and come up with new things that we've never heard of. But the real long-term challenge is how are they going to create inflation? How are we going to get money out in the economy when it's actually the system isn't working at all?
Yeah. I'd like to ask you about gold. So with gold is typically you would think of it being good in an inflationary environment, right?
Mm-hmm.
And that's kind of traditionally been the hedge for inflation.
Right.
Today, gold has been doing really well. I think people are expecting inflation, but we're probably going to end up with deflation. Two parts to this gold question, I guess. The first part being, one, it looks like there's way more fundamental reasons why gold could take off today than just inflation. So, for example, interest rates are at 0 or negative. Why not just hold gold? If currencies collapse, why not hold gold? And so those are non-inflation based reasons to own gold. So I guess first, what do you think about that?
Yeah, so I'm short-term bearish, long-term bullish on gold. And yeah, in the short term, people will. So why are people bidding gold up? You look at the same. You look at like say Bitcoin. There's a lot of similarities to that and tech stocks. Why does everyone do it? They really believe inflation is coming. Now they actually part of their belief is the dollar is going to lose value because somehow, some way, all this stuff the Fed is doing and all the stimulus that the government is doing is somehow going to magically turn into an explosion of dollars. And so they're just lining up early to play the game. The problem is when it doesn't happen, now they're in these inflation assets. And, you know, there's this argument that gold does really well during deflation. But here's the problem. If I have less money and you have less money and everyone has less money, how does gold going to hold its value? Now, I know there's arguments that says, yes, it can go up in inflation, it can go up in deflation. The reality is it's more likely to have a pull down, a pretty quick move down like we saw in late 2008 before it takes that bigger move higher. That's kind of the way I look at it. And I know I could be wrong about that. And it's one of the most critical things. Wait till you read the comments of this show. Everyone's going to be like, man, that guy's a complete idiot because he thinks that. But that's just kind of my view is, the dollar isn't going to zero and is not likely to go down. The dollar is going to rally. And I think that's the key part people are missing. We're going to see the dollar strengthen, which will bring consumer prices down because we're an importing country. And when the dollar rises, generally you see gold go down. That's kind of my base case is the dollar is going to tell us everything.
I think it comes down to when you talk about the dollar getting stronger or weaker, dollar going up or down, compared to what, right? So then I think you have that, like, so gold, I mean, yes, you're right. In 2008, it took a 25% dip. Stocks went down 50%. Gold rebounded in 7 months. Stocks rebounded in like 6 years. So because of, and maybe, next year, if we have a big crash, we'll kind of see something similar. But the thing with gold is, let's say it goes down, or say it collapses to $1,000 with deflation. But it's not about being priced in dollars. What's the purchasing power of it? So did the purchasing power of gold stay the same or even go up, even though the US dollar value of it went down? Do you look at it in terms of purchasing power value as opposed to just like denominated in dollar value?
It should, but I think more people buy it as an inflation hedge. So, but the idea is that, a loaf of bread, so much gold bought a loaf of bread then that buys it now. That is a valid argument. And in a deflationary environment, when there's less money, well, obviously the value of consumer goods will drop, which is kind of where I come back to the fact that it does make sense that gold is likely to pull back. Does it mean it's going to zero? No, it just means that if you're looking to be in it, there may be another opportunity to buy at a lower value if you missed it.
Sure. All right. Well, we'll wrap it up with one more question, and we'll put you a little bit more in the hot seat. With gold, you were nice enough to say short-term bearish, long-term bullish. I'm just curious what your shorter term and longer term outlook is just on the overall market itself. So obviously, we know timing markets is impossible, but from what you see, I mean, we've talked about kind of having diminishing returns and the game can't go forever and things like that. Do you think that, this kind of starts to end or maybe has a pretty bad hiccup in the next year, and then they have this crazy intervention, which then shoots up? And what are you thinking for the next year, 2, 3 years?
I think things start to get really interesting in, say, 30 some days, and mainly it's because I'm watching the dollar. I think the dollar is getting close to making a move higher. When it does, then the whole system starts to unravel. So I think we're pretty close to seeing
before the election. Something big happens before the election.
Yeah, and it's not, in my view, isn't election based at all. It's just strictly I'm looking at the dollar, and I know the dollar is going to rally. It's consolidating, and I think it's got a little further to go. And then once it ends that and heads higher, then the real fun begins, because now we'll have low interest rates, which are tight financial conditions. We'll have the banks not wanting to lend, that's tight financial conditions. And now we get the third whammy. We get the dollar rallying, and then the system just can't handle that at all.
Yeah. All right. Well, it's going to be interesting to see how that plays out. The beauty is none of us have a crystal ball, and none of us know, and we all have our best guesses in the way that we interpret the cards, I guess, so to speak. I've seen many technical analysis analysts saying that the Dixie looks weak and it's ready for another drop. So
yep.
Who knows?
I disagree with them, but well, I guess we'll find out. I'm very much in the minority on that view, but we'll see who's right in the end.
Yeah. Well, Stephen, it's been such a great time talking to you. Such a great conversation. Maybe we'll dive into that rabbit hole another time. But I want to make sure that everybody goes and follows your YouTube channel. So I'm going to make sure to link that down below. We'll try and get you a bunch more subscribers. Anywhere else that anyone should follow you?
Yeah, I appreciate that. So 3 days a week, I do kind of a macro show. We look at the economic data, and right now it's very much bond themed because I'm the self-anointed bond king, and bond is macro. So that's a great place to find me. And we also do a Sunday chart show for those who are more looking for the technical analysis. And then you can also find me on Twitter at, even though it's mispronounced, it's at Metre Stephen, M-E-T-R-E Stephen, even though it's actually Van Meter. So there you go. Your fans will have fun with that.
Got it. All right, Stephen. Thank you so much.
Mark, it's been a real pleasure to meet you, and thank you for having me on your show.
All right.